Are political donations just a form of legal bribery? George Gammon from Rebel Capitalist is about to drop some truth bombs.
That's right. George, known for his sharp economic analysis, uncovers what he calls the biggest political money laundering scam.
In this video, we've distilled his deep dive into easily digestible insights. We're saving you a ton of time.
George starts by exposing how political donations can be secretly used to influence policy for personal gain. Quick reminder, this content is for informational purposes only and not financial advice.
Today, we're diving deep into a controversial topic, political money laundering, and we're looking at George Gammon's take on it.
Right? George, from Rebel Capitalist, is known for his sharp analysis of economic and political systems, and he's not holding back on this one.
Exactly. He's exposing what he calls the biggest political money laundering scam, and it's got some serious implications for how our systems work.
Absolutely. This is about understanding how money flows in politics and who really benefits from it. Let's get into the thesis of his argument.
George Gammon's central argument is that political donations are often used as a form of money laundering, where the true source and purpose of the funds are obscured.
Right. He suggests that these donations can be used to influence policy decisions, reward donors, and enrich politicians and their allies.
He points out that the current system of political finance is riddled with loopholes and lacks adequate oversight, which allows for these schemes to thrive.
Exactly. It's a system that's ripe for abuse and in need of serious reform.
George Gammon emphasizes the need for greater transparency and accountability in political finance to expose and combat these illicit activities.
Absolutely. He believes that sunlight is the best disinfectant and that we need to shine a light on the dark corners of political finance.
So what's the first key point that George Gammon makes about political money laundering?
He emphasizes that political donations can be a form of investment, where donors expect a return in the form of favorable policies or contracts.
So it's not just about supporting a candidate, it's about getting something back.
Exactly. It's a quid pro quo relationship that can distort markets and create unfair advantages.
George Gammon also talks about the lack of transparency in political finance. Why is that such a big deal?
He argues that the complex web of shell corporations and PACs makes it difficult to trace the true sources of political funding, which allows for illicit activities to thrive.
So it's like trying to follow a maze with no map.
Precisely. The opacity allows for money to be laundered through the system without detection.
George warns about the potential for foreign interference in elections through political donations. How does that work?
He explains that foreign entities can use intermediaries to funnel money into political campaigns, influencing policy decisions and undermining national sovereignty.
So it's like a backdoor to influencing our political system.
Yep. It's a serious threat that needs to be addressed with stronger regulations and enforcement.
What does George Gammon predict will happen if these political money laundering schemes continue unchecked?
He suggests that it will lead to increased corruption, erosion of trust in government, and a further concentration of wealth and power in the hands of a few.
So it's a slippery slope toward a more unequal and unjust society.
Exactly. It's a self-reinforcing cycle that needs to be disrupted with meaningful reforms.
George Gammon also talks about potential solutions to curb political money laundering. What are some of his ideas?
He advocates for stricter regulations on political donations, greater transparency in financial transactions, and stronger enforcement of anti-corruption laws.
So, it's about creating a more level playing field and holding wrongdoers accountable.
Yep. He believes that these measures can help restore faith in our political system and promote a more fair and equitable society.
So what are the key takeaways from George Gammon's deep dive into political money laundering?
Well, George emphasizes the importance of understanding how political donations can be used to influence policy and potentially benefit donors.
Right? It's not just about supporting a candidate. It's about the potential return on investment.
Exactly, and George suggests following the money trail to see who's really benefiting from certain policies.
George Gammon also highlights the need for transparency in political finance. How can we achieve that?
He argues for stricter regulations on political donations and greater disclosure requirements to expose potential conflicts of interest.
So more sunshine on the process?
Yep, sunlight is the best disinfectant, as they say. George believes increased transparency can help curb corruption and undue influence.
George Gammon warns about the potential for political donations to distort markets and create unfair advantages. What can be done about that?
He suggests being aware of how policies are shaped by money and supporting efforts to level the playing field for businesses and individuals.
So it's about being a more informed and engaged citizen.
Absolutely. George's analysis underscores the importance of understanding the political economy and advocating for policies that promote fairness and competition.
Today, we are breaking down recent retail sales data and what it signals for the economy, drawing insights from Jeff Snyder at Eurodollar University.
Jeff's analysis focuses on the nuances within the data. It's not just about whether sales are up or down, but what's driving those changes.
Exactly. Jeff dives deep into the underlying trends and potential impacts, offering a critical perspective on the numbers.
So, forget the surface-level headlines. Let's dive into Jeff's analysis to understand what's really going on with consumer spending and the economy.
Jeff Snyder's analysis indicates a collapse in retail sales, signaling a potentially major economic meltdown. Is this just a doom and gloom scenario?
Well, Jeff's not exactly known for sugarcoating things, but he digs into the data to see what's actually happening with consumer spending.
So it's not just about the headlines, but the underlying trends that Jeff is watching closely. Jeff focuses on the specifics of the retail sales data to understand the real implications for the economy.
Exactly. He's looking beyond the surface-level numbers to identify potential weaknesses and turning points.
Jeff is basically saying, we need to pay close attention to where consumers are cutting back and why. Jeff Snyder points out a significant drop in retail sales, suggesting a potential economic meltdown.
Yeah, the numbers don't lie. But is it really a meltdown or just a cooling off after a period of high spending?
Well, Jeff emphasizes the magnitude of the decline and the potential consequences if it continues. Jeff highlights that this isn't just about one bad month. It's a trend that could indicate deeper problems.
True, 1 month could be an anomaly, but sustained weakness? That's a red flag.
So, we are not just talking about a minor dip. Jeff thinks this is a sign of something more serious brewing. According to Jeff, collapsing retail sales can lead to reduced production, job losses, and a slowdown in overall economic activity.
That's the domino effect. Less spending means less demand, which means businesses cut back. It can snowball quickly.
Jeff is basically painting a picture of a potential recession driven by consumer pullback. Jeff Snyder suggests that if retail sales continue to decline, we could see a significant economic downturn in the coming months.
Okay, so Jeff is giving us a pretty grim outlook if this trend persists. What's the alternative scenario?
Well, Jeff doesn't seem too optimistic, but a stabilization in consumer spending could prevent the worst outcomes. According to Jeff, a potential rebound in consumer confidence and spending is crucial to avoid a severe recession. But that looks unlikely.
So it's not just about the numbers, it's about the psychology. People need to feel secure enough to keep spending.
Jeff implies that consumer sentiment might need a serious boost to turn things around. Jeff Snyder emphasizes that weaker retail sales figures can signal broader economic weakness.
Right? And it's not just about people buying less stuff, it's about what that pullback indicates about overall financial health. Think of it as a warning sign.
A warning sign that, if ignored, could lead to some really bad outcomes. Jeff also suggests monitoring consumer credit and spending habits.
Absolutely. If people are relying more on credit to maintain their spending, that's not sustainable. It's like a house of cards waiting to collapse.
Today, we're diving into Clem Chambers' views on the potential major reprice of all assets.
Clem's analysis suggests we might be on the verge of significant shifts in the financial landscape. It's a wild ride ahead.
Clem believes traditional investment strategies might need a serious rethink. What's driving this?
Clem points to factors like inflation, debt levels, and geopolitical tensions as key drivers. Buckle up.
Clem Chambers believes we might be heading for a major reprice of all assets. What does he mean by that?
Clem is suggesting that many assets are currently overvalued and could experience significant corrections. Think dot-com bubble, but potentially across the board.
So a broad market reset?
That's the gist of it. Clem thinks a lot of the gains we've seen in recent years are unsustainable.
What's driving Clem to this conclusion?
Clem points to factors like rising inflation, high debt levels, and geopolitical instability. He sees these as major headwinds for the markets.
So a perfect storm of economic challenges.
Exactly, and Clem thinks this could lead to a significant repricing of assets as investors reassess their risk.
Clem Chambers highlights the unsustainable levels of global debt as a major threat. What's his take?
Clem sees debt as a ticking time bomb. Sooner or later, something's got to give, either through inflation, defaults, or some other crisis.
So we're basically kicking the can down the road until it explodes.
Pretty much, and Clem suggests that when it explodes, assets will be significantly repriced.
What sectors or assets does Clem think are most vulnerable?
Clem is particularly concerned about overvalued assets like certain tech stocks and real estate in bubble-prone areas. Big downside potential there.
So those to-the-moon investments might be coming back down to earth with a bump?
That's Clem's view. He thinks a lot of these assets are priced for perfection, which is rarely the case in the real world.
Clem Chambers talks about central banks' actions to combat inflation. What's his analysis?
Clem believes central banks are in a tough spot. If they raise rates too aggressively, they risk triggering a recession. If they don't, inflation could spiral out of control.
So they're stuck between a rock and a hard place.
Exactly. And Clem thinks their policy decisions will be crucial in determining the direction of the markets.
How does Clem see these actions impacting different asset classes?
Clem suggests that rising interest rates could put pressure on stocks and bonds while potentially benefiting hard assets like gold.
So gold might shine as other assets struggle.
That's Clem's thesis. He sees gold as a safe haven in times of economic uncertainty.
Clem Chambers has a bold prediction about gold. What is it?
Clem predicts that gold could reach as high as $5,000 per ounce. He sees it as a hedge against currency debasement and economic instability.
5,000. That's quite a jump. What's driving this?
Clem points to the potential for a major economic downturn and the loss of faith in traditional currencies. In that scenario, gold could become the go-to safe haven.
What needs to happen for this prediction to come true?
Clem believes a significant economic crisis or a major geopolitical event could trigger a rush to gold. Keep an eye on those black swan events.
Okay, so crisis equals gold rush?
That's Clem's take. He thinks gold's value will surge as other assets falter.
So what's the bottom line for our viewers based on Clem Chambers' analysis?
Clem emphasizes the importance of diversification and being prepared for volatility. Don't put all your eggs in one basket.
Got it. Diversify or get wrecked.
Exactly. Clem is very adamant about that.
What indicators should investors watch to stay ahead?
Clem advises monitoring inflation data, central bank policies, and geopolitical events. These will heavily influence market movements.
Okay, so eyes peeled on the Fed and the headlines.
Yep. And remember, Clem's perspective is that gold could be a valuable asset in this environment.
Today, we are diving deep into the bond market with insights from Jim Grant, the legendary market historian and publisher of Grant's Interest Rate Observer.
Jim has been analyzing financial markets for decades, and he's not exactly singing a happy tune right now.
He's known for his deep understanding of market history and his contrarian views. In fact, he thinks we're in a multi-decade bond bear market.
Yep, and as Jim Grant sees it, investors should be prepared for rising interest rates and potential turmoil in fixed income markets.
Jim Grant's thesis is pretty straightforward. We are in a multi-decade bond bear market. What's driving this view?
Well, Jim believes that years of ultra-low interest rates and quantitative easing have created a bubble in the bond market. Now that central banks are tightening monetary policy, that bubble is likely to burst.
And what does that mean for investors?
According to Jim Grant, it means that traditional fixed income investments may no longer provide the same level of safety and returns they once did.
So is Jim Grant saying bonds are dead?
Not necessarily dead, but definitely wounded. Jim believes that investors need to be much more selective and cautious when it comes to investing in bonds.
Let's dive into some specifics. What does Jim Grant say about quantitative tightening?
Jim notes that the reversal of quantitative easing, quantitative tightening, is putting upward pressure on interest rates.
So the Fed is shrinking its balance sheet, and that's driving up borrowing costs?
Exactly. As Jim Grant explains, this means less liquidity in the market and higher yields on government bonds.
And how is that affecting corporate debt?
Jim emphasizes that higher interest rates make it more expensive for corporations to borrow money. Many companies may struggle to refinance their debts, leading to potential defaults.
So, companies that binged on cheap debt during the low-rate era are now facing a hangover?
Precisely. And Jim believes this could trigger a wave of corporate bankruptcies if rates continue to rise.
Where does inflation fit into Jim's analysis?
Jim points out that while inflation may have peaked, it's likely to remain stubbornly high. Central banks may be forced to keep rates elevated to combat rising prices.
Which means more pain for bondholders.
Yep, and Jim Grant thinks this could lead to further losses in fixed income markets.
So what does Jim Grant see on the horizon?
Jim Grant believes that the bond market is in a multi-decade bear market. This means that bond prices are likely to fall and yields are likely to rise over the long term.
That's a pretty grim outlook for fixed income investors.
Indeed. And Jim thinks that investors need to adjust their strategies accordingly.
What's the biggest risk Jim Grant is watching right now?
Jim warns that excessive debt levels in the global economy could lead to a financial crisis. He believes that rising interest rates could trigger a wave of defaults and bankruptcies, particularly among over-leveraged companies.
So, we're talking about a potential debt implosion.
Yep. And Jim Grant thinks that investors should be prepared for a period of increased market volatility and economic uncertainty.
So what's the takeaway here?
Jim Grant suggests investors closely monitor the yield curve, especially the spread between short-term and long-term Treasury yields. Inversion could signal recession.
In other words, if short-term bonds pay more than long-term ones, batten down the hatches.
Precisely. And pay attention to the level of corporate debt. High levels could trigger defaults if interest rates continue to rise.
What else should we keep an eye on?
According to Jim Grant, keep an eye on the credit spreads, the difference between the yields of corporate bonds and government bonds. Widening spreads can signal trouble in corporate debt markets.
So if the gap widens, that's a red flag for corporate bankruptcies.
Yep. And as Jim notes, it's always wise to maintain a diversified portfolio, focusing on high-quality assets during periods of uncertainty.
Today, we're diving into market analysis with insights from Matt DeWolf of Trade Brigade, focusing on recent bull traps and potential market corrections.
Matt uses technical analysis to find key insights and actionable signals in the market.
Matt's analysis blends technical indicators with real-time market sentiment, aiming to give traders an edge in volatile conditions.
Exactly. Let's break down Matt's latest takes on Bitcoin and what those insights mean for your trading strategy.
Matt DeWolf's thesis focuses on identifying potential bull traps in the current market conditions.
These are situations where the price looks like it's breaking out, but it's actually a setup for a fall.
Matt emphasizes the importance of not getting caught up in the hype and understanding the underlying market dynamics.
Right, don't just jump on the bandwagon without looking at the road.
Matt DeWolf points out that any breakout without strong volume is suspect. It might just be a trap.
Right? Think of it like this. If no one's actually buying, the price ain't going anywhere.
He emphasizes that traders should look for increasing volume to confirm the validity of a breakout. Otherwise, it's just noise.
So no volume, no party, got it.
Matt suggests extreme optimism in the market is often a contrarian indicator. When everyone is bullish, it's usually time to be cautious.
Yep. If your grandma starts asking about Bitcoin, it might be time to trim your positions.
According to Matt DeWolf, traders should be prepared for sudden corrections when markets seem too good to be true.
Basically, don't get caught holding the bag when the music stops.
Matt DeWolf suggests traders closely monitor the volume confirmation of any breakouts, especially in Bitcoin.
Right? No volume means no conviction. Oh, just a bunch of hot air.
Matt also emphasizes the importance of not blindly following the herd, especially when markets look overly optimistic.
Yep, basically, if everyone's screaming to the moon, it's time to quietly head for the exit.
What an enlightening discussion we just had. Each of our experts brought some serious insights to the table.
Indeed, it was fascinating how Matt DeWolf stressed the need for business adaptability during these turbulent times.
Absolutely, and Jim Grant's emphasis on historical trends really adds depth to our understanding of today's market.
Plus, Clem Chambers dialed in on market psychology, such a crucial factor that often gets overlooked.
Right? And Jeff Snyder's perspective on the liquidity cycles sheds light on another vital aspect of our economic landscape.
Yet we did see some differing viewpoints, like Matt advocating adaptability, while Jeff suggests liquidity should take the forefront.
And how about Jim's historical take versus George's macro focus? Such intriguing contrasts.
These diverse ideas really offer us valuable insights. If you found this discussion enlightening, don't forget to hit the like button.
Oh yes, and subscribe for more content. You won't want to miss the valuable expertise we have lined up for you next.
Stay engaged, and remember, knowledge is power in navigating this complex financial world.
Thanks for watching, and check out our other videos for more expert advice.